Earnings season continued this week on Yahoo Finance. We heard from some huge names like Bank of America, Morgan Stanley, Goldman Sachs, Netflix, and Tesla. The reports have been mixed as companies are dealing with high interest rates, economic headwinds, and concerns over consumer spending. Here's a recap of the results.
First of all, financials usually kick off earnings season. They set the tone. Everybody sort of waits with bated breath to see what the CEOs are going to say. And financials do have a really good lens, particularly the big financials, a really good lens into what the consumer is doing. So not only if the consumer is spending, but if the consumer is still borrowing. So what I heard, generally speaking, from them is that absolutely there's still an appetite to spend. It's still happening. However, there are consumers that are doing it on leverage or on credit. And so far, that is perfectly fine because everybody is still employed in a strong labor market and there's been wage growth. We see real wage growth actually coming back, which is also great. But at some point, right, if that credit gets extended, that's when you start to get concerned. But right now, everything sounds like it's still going well. Obviously, the consumer is a huge part of the U.S. economy. There is no such thing as an economic expansion without the consumer. So if they're spending, that's positive, and I think earnings season has been off to a good start with the financials.
But was the bar already kind of set low, especially like, we just heard when you talk about Bank of America, sure, they beat, but it was lower than quarter over quarter from its previous quarter. Mm-hmm. And was there anything concerning in the financials, in the financial sector for you?
Well, of course, the bar is absolutely still low. The bar is pretty low across the board, and we're expecting negative 7% growth. That's what consensus expectations are for this quarter. So it's not that difficult to leap over a negative 7% number, right? So yes, it's true that the expectations are kind of not impressive, right. I guess. Concerns in the financials, I think there are a lot of risks that we already know. So obviously we know what happened in March. Mm-hmm. We saw this sort of mini or medium-sized financial crisis in the regional banks. We know that still lurks out there, maybe an issue. There are some data points that we got already from CEOs saying that deposit growth was down. Now, that could either be an indication that things are getting weaker, or it's just a rational investor behavior thing where you've got treasuries offering a good yield, you've got money markets offering a good yield. Rational investors, rational depositors would take their money and go get the higher yield. So if at some point rates do fall and money markets and treasuries stop offering that kind of rate, people will put their money back in deposits, right? So this could just be kind of a transient move of money away from deposits that are not offering a good yield. So that is one of the concerns that is starting to bubble up to the top. And then you've got basically yield curve inversions. I talk about them so often. Anybody who asks me questions is like, oh my God, when is she going to come off this yield curve inversion thing? I'm not going to until it goes away, right? But you've got these curve inversions that are warning. Usually what they warn is that you've got some kind of financial stress that's coming. Well, we saw some financial stress in March, but they usually also warn that there could be a credit deterioration coming. And that we haven't really seen yet. So this growth in credit card spending, this growth in leverage on the consumer does open up the possibility and increase the risk that credit deterioration would hit a little bit harder.
What you're seeing is that on a year-over-year basis, the numbers look pretty good. But on a quarter-over-quarter basis, it shows that there is some weakness developing. And I think that's traditional. Well, I shouldn't say traditional. I think that's similar to what other banks are showing in the quarter. In other words, what we're seeing is if you're solely in the banking business, PNC, for example, you're not doing particularly well. If you have a big capital markets operation to assist you, and we'll say, J.P. Morgan or, a company like, Wells Fargo, what you're seeing is some strength in that area. So I'd say that what Bank of America is doing at the present time is showing those trends. The banking industry weakened, the banking business weakened in the quarter-over-quarter results, and they were surprisingly strong in the capital markets arena. And I think if you're looking forward for banking, Again, you have to make your call on whether there's going to be a recession or not. But if you're looking forward, I think that the trends that you're likely to see are similar to what we saw in this quarter. I think that you're going to see capital markets activity being very strong over the next few quarters. You're going to see banking being lackluster. You'll see some little pickup maybe in commercial industrial lending, but, home mortgages should be flat, and you should see, credit card lending, which was extremely strong, coming down somewhat as people are borrowing a little bit too much right now for their income.
Yeah, we did see an increase in credit card write-offs for Bank of America, although it's still well below where it was even pre-pandemic, which is interesting. Something else that stuck out to me, Dick, is consumer unit deposits, which were down 1% quarter over quarter. On a relative basis on that front, how is Bank of America doing versus its competitors?
Well, again, JP Morgan's numbers are all messed up because of the acquisition of First Republic. If you took the First Republic numbers out of JP Morgan, okay, you would see that JP Morgan's, if you will, organic numbers were down across the board. So I know people get very enthused about the JP Morgan numbers, but they tend to forget that they're not as a result of organic growth at JP Morgan. They're the result of a major acquisition, which gave them $2.7 billion in profits. All right, so if you take a look at the deposits at JP Morgan, you take a look at the deposits at Wells Fargo, if you take a look at the deposits at Bank of America, they're all feeling the same stress, and they're feeling that stress for a very logical reason. The banks are cheating the depositors. I mean, basically, the banks got this huge windfall gain as a result of something that they had nothing to do with. The Fed increased interest rates, and they didn't pass it along to their depositors. So the result is that on a deposit basis, even the big banks are showing declines in deposits, despite this theory that everybody's taking money out of the regional banks and putting it into the big banks. I'm not seeing that. Although PNC's deposit numbers were not particularly good at all in this quarter. I think that, if the banks want these deposits back, it's easy to get them back. All they have to do is raise their rates to closer to a market rate. They are reluctant to do that, however, because their margins are not doing well. So, they're in a box. They're in a box because, the yield on their assets are not enough to allow them to pay market rates on deposits. So they don't pay market rates on deposits, and the deposits go to money market funds or other areas, but they don't stay in these banks.
So in their earnings report, net charge-offs increased to $869 million. So it's up from a year ago. And total loan loss levels are at $602 million. Is that concerning at all for you, for Bank of America, Dick?
Yes, it is. I think that what you're going to see is, a very, very significant increase in loan losses in the consumer sector over the next couple of quarters. I can give you a simple example, which tends to bring to bearing what I'm talking about. One of my friends called me the other day and said that he bought a car 3 years ago for $63,000. The book value of that car, the blue book value of that car today is $36,000, but the size of his loan is $45,000, and he's got 4 years to go in paying for that loan. If you multiply him by hundreds of thousands of auto buyers over the last, 3 years, you'll find that they're in a similar situation because used car prices are coming down, and they took these 6 and 7 year loans outstanding, and that is going to hit them hard. And not every one of them is going to pay, to continue to make the auto payment. And if unemployment were to rise at all, then you would see a substantial increase. The same deal is going on with credit cards. People, got this huge largesse in terms of all of this money dumped into their pocket by the government, a few years ago. That money has now been spent, and so now they're borrowing, and they're not borrowing on necessities. They're borrowing on tourism, on homes outside the house, on a variety of recreational products. So, I think the consumer is in a very vulnerable position, and I think that loan losses will increase substantially, as I said a minute ago, over the next few quarters.
We basically said that since last earnings call, we felt more comfortable that we'd have a better outlook for NII in the second half of the year than we did then. And it'd be basically flattish quarter to quarter between 14.2 and 14.3, and then be above 14 in the fourth quarter. And that really comes from just the sheer power of our franchise, whether it's we're getting 4% annualized loan growth, which is good on the commercial side especially. We're seeing some card growth. We're seeing the deposits hang in there, even though, because we have such excess funding position, we're not competing for high-cost deposits. We put those customers' money into the market and money funds and other things, and we actually even raise money from our customers for other banks to give them those rates because we don't have a use for the cash. And so even with all that going on, we feel good about the NII, and that's basically due to the power of our deposit franchise.
Is this outlook, Brian, your way of signaling to markets that this economy is going to see a soft landing from the various actions the Fed has taken?
Yeah, it's a little chicken and egg. We build our outlet based on the market expectation for rates. But let me back up, Brian, and talk about we have our research team led by Candace Browning-Platt that does tremendous work, and they basically have the first two quarters of 24 to be slightly recessionary, -1% GDP growth rate in the first quarter and 0.5% in the second quarter. So that's a pretty light recession at this point. And they've moved it out from this year into next year, and they've moved the duration to be shorter. So as you think about it, whether it's a soft landing, meaning it never goes negative or it goes slightly negative, I'm not sure people will feel the big difference. And what we're seeing in our customer base is the economy, the spending that goes on in our customer base, which is $4 trillion plus a year, which was growing at 10% a year for all the year 22 over 21, for example, has now slowed to 5%. And that 5% is very consistent with a low inflation, more normalized growth economy in the U.S., kind of what it was in 17 or 18 or 19. And that's good news, frankly, because that means the economy is getting back in line, even though we haven't had massive dislocation in employment, although employment markets are softer than they were a year ago at this time.
Are you surprised by this consumer resilience?
I'm not, honestly, and we've been saying this for a long time. This was going to be the Fed's hardest job, was to slow down the U.S. consumer, because at the end of the day, the amount of stimulus the consumer had, the fact that unemployment has run as low as 3.4%, the fact that wage growth, you see a lot of talk about what's caught back up to inflation, but if you go look at from the pandemic forward, the wage growth from 19, 20, 21 was very fast, and then it fell behind inflation, but cumulatively it's ahead of inflation. And so if people are working and they're getting paid more and they're spending, it's going to be hard to have a tough U.S. economy because of the amount that's driven by that. But on the other hand, you don't want them doing too much and feeling like they're getting behind on inflation, therefore demanding higher wages to get in a wage inflation spiral. It looks like the Fed's was probably too late, and they said it themselves, of getting in the game and raising rates. Then they finally moved very quickly, and they've caused that to slow down. And I think that's all good. But I'm not surprised by the resilience of the consumer, because when we looked at our customer data, you can go back and track us talking quarter after quarter. Our customers still have multiples in their accounts. So the same customers that were here in early 2020 today have multiples in their accounts than they did back then, especially in the lower balance accounts. And that's because they've spent some of the stimulus, but they've been earning money and they've been managing their finances well. That doesn't mean certain ones are having difficulties and layoffs are happening. But in a broad context, across 60 million customers, across $4 trillion of spending, it's a pretty resilient group.
Do you think consumer spending, Brian, will surprise to the upside later this year? We are now finally starting to see inflation slow pretty dramatically in this country. And looking at your results, to your point, you have a lot of people with a lot of money in savings and checking accounts that maybe they could get out there and spend in the back half of this year. How do you see it?
Well, if you think about the last few years, first it was good spending. They bought things because they're pent up in a house and they just had money and they bought stuff, and so they bought a new couch or a new grill or things like that. But you can only buy one of those. So then they started spending on what we called experiences, going out to eat, going out to movies, going on trips, and you still see travel's fairly strong, and you can see the bookings. I think all that, once people have done a lot of that, gotten a normal summer vacation in for their kids out of school, I think it'll sort of reach what it usually does. Is sort of 3, 4, 5% going faster than the rate of inflation, because the wealth of the country grows, and I think that's good. Now, the best news is that the credit worthiness of our customers is still extremely strong. And people keep talking, I get asked about, well, your credit card charge-off rate went up a little bit, or your 90-plus delinquencies went up some. But if you look at that number, it's still far below where it was in 19. And if you and I were having this conversation in 19, we'd be talking about 30 and 40-year record lows of credit costs in our company. And that's we're normalizing to a very good place. And so I think that also means the consumer has some staying power, the equity in their home. And so, in the end of the day, if companies are making money and employing people, even though it's not as aggressive out there in the markets today on labor, people are going to have jobs and people are going to spend. But I think they're slowing down their activities because, frankly, if all they read about in the papers are going into recession, that kind of has an effect. And if things like a new car cost a lot more in interest rates, or a new home mortgage rates above 7%, those slow down the activity. But that's what the Fed intended to do.
Yeah, Brian, I think this is the recession that everybody's been calling for a while. It just may not happen. But I want to go into commercial real estate. I looked at your results. When I see your results, I don't hear you calling out big negatives on commercial real estate. Why is that the case for a Bank of America, but a completely different story over at a company like Wells Fargo?
Well, I can't reflect on other people, but we disclose. It comes from what we call responsible growth. For a long time, we've looked at, in the commercial real estate business, to keep that as a percentage of our loans at a size in total, and even the office piece of that, to work with great sponsors of people in the buildings, great real estate owners, and then, frankly, make sure the terms are reasonable. And so as you look across time, that's served us well. So we only have about $18 billion outstanding in office properties, about a couple percent of our portfolio or less. We aggressively re-rate that based on the current conditions. At origination, it was a 50% loan to value. For all the reappraised stuff in the last 6 months, the average loan to value is only 80%. And so, yeah, there's stress going on in the system, but we underwrote, assuming that someday there would be stress. And the trends that have gone on about real estate optimization by companies, including our own, have been going on for a long time. It's just they've been changed a bit by the work from home and the 3-4 days a week and all that stuff. Just to give you an example, when we started with the management team in 2010, in our company, we had 130 million square feet that we utilized. Today, we utilize about 60. So this is a long-term trend of efficiency and use of office space that will continue. It just got pushed ahead by the work from home dynamics.
Do you share the concerns that some of your peers have on the outlook for commercial real estate?
I think, look, that's going to be building specific and city specific, and whether people work. And so, as we do a lot in New York, and you look down the street, you walk out on 6th Avenue outside a building, you get run over by people. In town, in other areas, it's not the same. And then there's places, back and forth. And so you've read about San Francisco, a place like that. I think over time, these things will normalize. But I think what we have found so far is we lend to newer buildings and high quality buildings, and those tend to be doing better right now. But I guarantee you, the entrepreneurial spirit of America out there, when the right real estate values come up, people come in and reposition these assets like they've done for many times in the past.
Brian, you also called out something I think of great interest this earnings season for the banks, the potential for higher capital requirements. And I believe this was your stat. A 10% increase in capital requirements, if that does happen, might lead to $150 billion less in lending. That sounds to me like a big economic blow, or potential economic blow.
Yeah, so I think just to simplify that, if you say that we're at 10% required capital and you go to 11%, that 1% doesn't sound a lot, but that's $16 billion capital, and then you multiply it times 10 again, there's your $160 billion. And some people are saying, well, how can you get there? That's how you get there. So the reality is our lending capacity goes down. If you do this across the whole banking system, and that's why we're all awaiting these rules, but we hope that as the rules come out, they're balanced in terms of international competition. In other words, that right now, America and Europe appear to have the same rules, but they are advanced and we're in standardized. And if you listen, they're saying, well, we're going to go away from the models and all those things. That was the basis of Basel III, to get to advanced. So our advanced RWA are 1.4 trillion, our standardized are 1.6. So we have to use the higher under America's rules. That's not true in other locations. And so we have to be careful about keeping the balance and the competitiveness of the U.S. banking system, which is key not only to America, honestly, but it's key to the whole world, because the strength of our banking system actually helps the world prosper. The second thing then is the capacity inside the industry versus outside the industry. And so if you think about outside the industry, you have half the mortgage loans are done by non-banking companies. You have the new private capital funds being formed. Will those companies perform like we performed when the pandemic hit and $70 billion of loans came on our books in 3 weeks from our customers in demand? Will they be able to have that kind of shock absorptive system? Will they be able to behave and absorb the turmoil that went on earlier this year? That's not clear to me. And the history has been paved with companies that have been in these businesses not been able to stand those shocks. So, I think that it's good for the banking system to have a lot of the economy running through it, but using the capital markets to lay that off and using the investor system to lay off, loan syndications and things like that. But if you make the capital rules so tight in banking, the stuff gets squeezed out. So remember, on an international basis, this is effectively a trade negotiation that's going on. If the rules are easier in mainland Europe than they are in the U.S., however you get there, whether standardized, advanced, or how you count the eggs and things like that, the reality is American companies will have a higher cost of borrowing versus European companies, of which they're engaged in the same competition in the supply chain for large companies, or large companies would have the same costs. And so I think that's why we have to be careful with these rules. A, international competitiveness, and B, making sure that we keep the balance right of how we treat the U.S. economy. And I hope and I believe, and there'll be, in the aftermath of these rules, there'll be a lot of discussion about what are the pluses and minuses of these rules.
We knew this was going to be a tough quarter and it was going to be messy, and I think that's exactly what it was. About 5% return on equity drag came from all these kind of unusual items, the marks on Green Sky and Marcus and some other marks in their equity book in asset management. And so those are items that, hopefully we don't see every quarter. And then, really the story here is going to be, one, do the capital markets recover? And we can talk about that, but we are starting to see some green shoots. So I think that's where the conversation is going to go as the day goes on here. But, it was a messy quarter directionally, as expected, but they have to, I think, own some of that, and so here we are.
Here we are indeed. Hey, Bill, it's good to see you. Devin doesn't sound that negative here. I know there was a lot of pressure and discussion over David Solomon's leadership going into this. As somebody who has tracked this company for a long time, do you think he is in jeopardy?
Well, Julie, it's nice to see you too. Look, when it comes to Goldman Sachs, where there's smoke, there's fire. There's been a lot of dissatisfaction during the course of this year with David's leadership. I think it's kind of crunch time. I think this was sort of a kitchen sink kind of quarter where they took their write down on Green Sky. They took their write down on their commercial real estate holdings. They've obviously dinged their net income significantly. Their revenues were down, but their expenses were not down nearly as much. So if David hasn't righted this ship in the third and fourth quarters, everything that I'm hearing is his tenure could be in jeopardy. But at the moment, I think he's okay. But he's got to get this thing back into a much more Goldman-like framework in the next 2 quarters.
Devin, I got to ask you, you did give the caveat about capital markets recovering and when do they recover. But with Goldman in particular, has it lost its edge given these results, or do we think this is kind of a one-off?
So you actually peel back the onion, and their market share is as good as it's ever been. They're actually still gaining share virtually across every business, and they're building in more stable businesses as well. Asset and wealth management, they're still seeing nice growth there. Their financing revenues are growing, which are stickier. This is really a function of the capital markets have been shut for the last 18 months, and Goldman is the most levered to that theme. People quickly forget how good 2021 was, and Goldman significantly outperformed, and everything looked great. We've been the opposite side of that trade for the last 18 months. To give you just a couple stats, equity issuance, if you just look at a long-term trend line, equity underwriting revenues would have to increase by about 60 to 70% just to get back to a long-term historical trend line, looking at 30 years of data. For M&A advisory, the long-term trend line of announcements relative to the first half of this year would have to increase by over 50%. So those are 2 big businesses for Goldman. It just gives you a little bit of an order of magnitude of how tough they've been. But if those recover, I think that takes care of a lot of this, I'll call it noise on the outside. It's just been a really tough backdrop, and Goldman is entirely levered to, essentially investment banking and capital markets.
It is entirely levered to that. But Devin, it tried to be levered to the consumer as well. And that seems to have been kind of a spectacular failure, no?
Yeah, I think it's definitely been a failure. It's a long conversation, I think, around what happened there. I think the market mood changed. Consumer is a business that, they probably would have had to build out for 10 years to get to the scale that would be relevant to Goldman. And that's the journey they were embarking on when interest rates went from 0 to 5%, and there was no appetite in the market for companies, whether it's within Goldman Sachs or a standalone tech company or consumer-facing company, to lose money. When that appetite changes, you have to make decisions. And so, that was a big driver of kind of paring it back. And this was going to be a really long build, and the market, I think, and investors lost appetite for that. And clearly, I think some internal friction as well, because capital markets were performing so well, and this was kind of dragging down overall results. It's a small fraction of what Goldman Sachs is and would have been for a number of years. So we're not losing sleep over it. You just need the capital markets to recover here, and that'll take care of a lot of the issues.
Bill, I want to ask you, what would it take to restore confidence in Solomon as a leader?
Well, I think, Devin is absolutely right. I mean, the capital markets have to improve. Goldman is highly levered toward investment banking. That market has been in the doldrums for the last year or so. He's trying to clean up the consumer banking foray. I mean, look, I can't blame him for trying that. Goldman is sort of in a box with the Federal Reserve. They can't really do what they need to do strategically because the Federal Reserve won't allow that kind of merger. They really need, a much bigger deposit base. They need a bigger commercial balance sheet. They need a lot of things they can't get just through organic growth. So David was trying something. He's gotten a lot of flack for his DJing and his use of private jets and sort of extracurricular activities. That's probably unfair. The stock is held up okay, but here's the thing. I think what we're seeing right now is a huge bifurcation in this market where you see, people with the big balance sheets, JP Morgan Chase and the deposit base, Bank of America, throwing up pretty amazing earnings under the circumstances. JP Morgan's net income was $14 billion. I mean, Goldman's was just a fraction of that. I mean, what you're seeing is this bifurcation where these companies that have a huge deposit base where they're paying nothing for those deposits can lend that money out at huge spreads with the rising interest rates, and that's just gushing to the bottom line. Goldman doesn't really have anything like that, and even in markets, they're paying up for those deposits much more than JP Morgan Chase or B of A is. So, they're in a bit of a box, but David's got a couple more quarters to figure this out. If he doesn't, I think the old guard is going to make a move.
And Bill, sort of on a related note, I remember when Goldman was the killer, right? It was just sort of the bank to be feared. And I guess that's a legacy of my coverage of them in particular during and after the financial crisis. Did they ever reattain that?
I mean, Devin is right. I mean, 2021 was an amazing year. I mean, more profits than, you need to sort of look over a 2 to 3 year period and then aggregate the profits. I mean, they sort of brought forward a bunch of profits that they've been missing out on lately. But in 2021, I think that, Goldman used to be able, Julie, you're absolutely right. I mean, obviously I wrote a book about it. They figured things out. They've always been the best at figuring things out, no matter the market conditions. And I'm wondering if they're figuring this out at the moment. It seems to have lost its swagger, its luster. It's still everybody wants to work there. Harder to get a job at Goldman Sachs than it is to get into Harvard. But still, they're not as feared like they used to be. People are fearing JP Morgan Chase at the moment. They're fearing what James Gorman has done at Morgan Stanley. But at Goldman, I don't know. And it's not the Goldman it used to be. Can it regain itself? Can it regain its 2021 swagger? My bet is it can, but, time is running out on David.
The short term is this is a situation of sell on the rumor and buy on the news. We had been expecting in our numbers big write-downs. You got big write-downs. And you, as a firm, can't have $1.1 billion write-downs every quarter as you pivot away from consumer, as you pivot away from an acquisition they did, GreenSky, as they pivot away from all these on-balance sheet investments. And by the way, a lot of write-downs for office specifically. So that's what's happening now. So the bad news is out there, and the stock's up today. In fact, I actually increased my estimates because you got some of the bad stuff out. In the medium term, it waits to be seen how soon the capital markets come back. You've had lower for longer investment banking. You've had less volatility for trading. So in some ways, it's the worst of all worlds, but the backlog is up at Goldman Sachs versus last quarter. And the question is, how much of that backlog do you convert and monetize to revenues? But the long term is what's really the big question here is. And Goldman Sachs is going back to the future by getting out of consumer, which I thought was stupid day one. You go back, any research, anytime I've been on your show, like why were they going? Nobody's using a Goldman Sachs credit card. I mean, this is Amex. This is Amex land, MasterCard, Visa.
I don't even mean that. I mean like the Marcus lending. You're going to lead off to the mass consumer in the United States with a lending product. Sure, that doesn't create sticky relationships. And then they go ahead and do that with a savings account by charging. That doesn't create sticky relationships. By the way, look at JP Morgan in London. They lead with a checking account where you interact several times a day. That builds sticky relationships. So I thought it was stupid, and the more it went on, it was even more ridiculous. So better late than never to pivot away from this. But now they're going back to the future. Their legacy over the past 150 years has been serving large institutions. So 2/3 of the company is global banking and markets, where they get mid-teens returns. They have number one leadership in mergers for 20 years. This quarter, equities did great. So that part of the business, nobody has too much question about. Another 1/3 of the company is wealth and asset management. They are doing better in the wealth business, but they have to get rid of some of these principal investments, which is a big drag from a regulatory perspective. And then there are extracurricular activities in consumer and some of these other things that they're getting rid of. So they get rid of the stuff that's extracurricular. They stay in their lane. They pivot and make themselves more balance sheet efficient and more operationally efficient. And then if and when these green shoots materialize, maybe they get from a lowly core, the ROE this quarter was 4%. This was the second worst quarter under David Solomon. Excluding the pandemic, it was the worst quarter in over 7 years for Goldman Sachs. So this is bad. You can't keep doing this. But their goal is to take it from the 4% or 9% adjusted for the charges up to 15% over the next 2 to 3 years. I don't have that. No one in consensus seems to have that. So no one's really believing David Solomon. So the bar is low. They're not trading too far above book value for a company that's grown book value faster than most banks. So I think this is an opportunity. The risk is that it just stays kind of dead money as other things go up. But this is a big pivot. This is a big day for Goldman Sachs. David Solomon is under pressure. So I think over the next year, we're going to have to see, some signs that they're going toward that 15% return.
Mike, do you think Solomon is the right person for this job? Is he going to be able to steer Goldman in the right direction? Because there has been, like you just said, tremendous amount of pressure, not only from shareholders, but even within the firm, from partners who haven't been happy with the direction.
Well, look, like anyone else at Goldman Sachs, David Solomon has to earn the right to be in his job every day. I think from a strategic standpoint, this idea of focusing on two core businesses, pivoting out of the stuff that isn't so core, is the right strategy. So really it just comes down to execution, and can they execute on their plans? And that's why I'm here, that's why you're there, that's why all the eyes are there watching them quarter to quarter to quarter. So right now, David Solomon is still there. He's actually, the stock price has outperformed since he's been there. Their capital markets activity has grown much faster than the others since he's been there. They've created book value faster. So on those metrics, it looks good, but I'm more concerned about the next 3 to 5 years. So yes, David Solomon is the right person at the moment, but I'm still watching closely quarter by quarter by quarter.
Mike, I've followed your work probably for well over a decade, and there's been a theme during that decade. The leaders that are still operating this business, leading these companies as CEO, are still entrenched. Brian Moynihan, I talked to him yesterday, very much engaged. Doesn't sound like he's going anywhere anytime soon. Maybe Jamie Dimon finally bows out as CEO in the next 2 to 3 years. He's been teasing it for 10 years or whatever it is. Morgan Stanley seeing a change in James Gorman in a year and a half. What has this current guard of CEOs meant to the financial services industry? And is the next crop of leaders, are they as good as these guys?
Well, these leaders were born out of the global financial crisis, which, as you recall, from 2008, 2009, was the biggest crisis since the Great Depression. And so they learned some pretty hard lessons. And so, these are survivors from that crisis. And so what doesn't kill you makes you stronger. And that's certainly the case with Jamie Dimon, which bought Bear and WAMU during the global financial crisis. Then he comes back again and buys First Republic and acts as a leader. So, look, I've had my spats with Jamie Dimon, and I just thought they were spending way too much a year and a half ago. Now they're showing incredible discipline. I mean, what company? I mean, you had an IPO on just now about beauty right before oddity. I thought banks might be that's the beauty. Banks are the beast, I guess. So today you have Beauty and the Beast. But I mean, what company? JP Morgan just guided for $10 billion higher in revenues between this quarter and last quarter, and guided for 0 increase in expenses. That's amazing. After all the criticism I gave Jamie Dimon, so you're not going to find too many Jamie Dimons coming along. In terms of James Gorman, I said in 2012, I upgraded the stock. I said either the stock price should go higher or he should be fired. And after that, James Gorman, it was an intraday upgrade after they had a terrible fixed income quarter. James Gorman picks up the phone, calls me. I thought it was a joke at first. And the first reaction by him, and he had his team, I had my team, he said, so that wasn't very nice. And I said, well, I just think the stock should go higher. He goes, so do I, and let me tell you why I think it will. So this idea of not acting defensive, you get red flags when people act defensive. You see it on your show sometimes. But this was the opposite of acting defensive, being open-minded. So I think that sort of open-mindedness, you can have that, you might not have that, but when someone gets in the position, do they actually act that way? And Brian Moynihan, I also thought he should be fired. I went to a special shareholder meeting a decade ago, and he proved me wrong. And frankly, I think I would have said the same thing a decade ago. I'm not sure he was ready to become CEO, but that just grinded out quarter after quarter, year after year, build a better mousetrap. So I think they're all good in different ways. So there's definitely an opening for new leaders to emerge, but they won't have been as battle tested as James Gorman, Brian Moynihan, or Jamie Dimon.
So I think there are a couple of things to look at here. And the first number that I believe most people look towards when the earnings came out is, of course, what's going on with subscriber growth. To start off this year, the two big questions were what is going to happen with the ongoing rollout of the ad tier, and then also can Netflix pull it off when it comes to launching its crackdown on password sharing and then having those paid shared accounts. And based off of these numbers, with 5.9 million subscriber ads, it does seem that they're building momentum in both initiatives. And that's definitely important because when it comes to underlying profitability, each incremental user from those shared accounts is directly contributing to that bottom line and can definitely create substantial opportunity for the company. And also just looking at the potential of this move, one thing that we've been hearing from experts is of the potential 100 million households that Netflix believed were sharing passwords before this initiative began, up to half of those could probably be ultimately converted to paid customers, which would represent significant growth for the company. And it does seem that they are moving in the right direction to start to capture some of that growth.
Jamie, how much of this, though, has already been priced into the stock? Because we're looking at shares under pressure after hours. Yes, their guidance came up just a bit light, but we've already seen so much of this optimism, it seems like, already baked in.
So if we think about where Netflix is going from here as a company, while it does seem to be seeing some progress, some momentum in a couple of these different areas, the future has its fair share of challenges. I think on the one hand, competition remains hot. There are so many players out here all trying to scoop up share as they work on scaling their streaming platforms. And there's also the degree of uncertainty around what exactly will the impact be of the dual strike in Hollywood. As of right now, pipelines are frozen. While there may be about a year's worth of material that Netflix is going to be able to release, that is the lifeblood of a streaming platform's success. And an ongoing concern about that can definitely have some consequences down the road, particularly as the velocity of content being released on platforms start to slow. From what we've heard, based off of what the experts we speak to say, Netflix is in the pole position in its ability to ride out this strike. But at the same time, if they start to see, or users start to see content not released as quickly, they might start to cancel their subscriptions, which could present certainly a large headwind down the road.
Jamie, it sounds like no catalyst ahead, at least from a positive standpoint for Netflix.
Well, if we're looking at catalysts, certainly we're in early days of the crackdown on password sharing. If we look at the launch in the US, that was only in May. We are only a bit more than a month or two into that. So there's substantial opportunity to capture some of that share and some of those users which were not previously paying. Also, at the same time, just circling back to the relative positioning of these different players, if we're looking at the impact of the writer's strike, in addition to Netflix have a decent amount of pipeline, it has that international footprint. It has that international production capabilities that not all of its competitors have. If we're looking over at a Paramount or a Lionsgate, for example. So there are definitely some areas where Netflix can feel pretty good about its ability to manage some of these challenges down the road. But it is worth understanding that it still remains competitive. There still remains a number of pressures in this industry and a degree of uncertainty to consider as well.
Jamie, what do you think is going to be the fallout, or maybe what's going to happen here to Netflix's business, given the fact that it is getting rid of its lowest price ad-free plan? Is that going to be, where do you see those users going? How many of those do you expect to upgrade to that higher price plan versus dropping down to that ad-supported tier?
It's a really good question, and this is one of the interesting questions for Netflix because ultimately it comes down to, of course, how much are users willing to deal with ads and how much are they willing to pay not to have that. What's interesting from Netflix's standpoint, and this is what we've been hearing from our experts, is that for them, for a while, it has been much better for Netflix to have users on the ad-supported tier because in addition to the basic fee of $7 a month, they can generate upwards of $5 to $6 in ad revenue on top of that, which would make it overall a larger revenue contributor than that basic plan which Netflix just canceled. So by and large, for them, if users do navigate towards that ad-supported tier, that could be a windfall in terms of generating increased revenues per user. But at the same time, certainly, I'm sure Netflix will be happy to see people get into those more higher price plans, which can definitely contribute to stronger ARPUs as a whole.
And Jamie, so we have really some better than expected paid additions from Netflix. That's good for Netflix, but is that bad news? And I'm just looking at some of the competitors here. Paramount, you have Disney Plus, and you have Hulu. Are we looking at a really disastrous earnings season from all the streamers not named Netflix?
So one of the big things to keep in mind for those other streamers, the fact that, of course, for them, in addition to trying to scale their platforms, try to make the economics work for that part of the business, they still are trying to support the legacy linear distribution model, be that through box office results or cable or the fall movie lineups. And for them, we might really start to see some pressure, which was already mounting over recent quarters, on top of that, then having the disruption of the dual strike out in Hollywood. What we've been hearing from our experts is that basically the fall lineups are already considered a wash. So a player like a Warner Brothers Discovery, a Paramount, a Disney will really start to feel some pressure on that portion of their business. And then on top of that, still facing the competitive pressure when it comes to their streaming offerings. So there's definitely a lot to be seen as we get those earnings results and get a sense check for where these different companies are. But it's looking at those which are still straddling the line here with the traditional linear distribution and the streaming platform, they do have an added amount of challenges which they're trying to navigate.
A lot of people were looking at auto gross margins, right? Not the headline gross margin. Auto gross margins about 17.5%. We're in line with what a lot of the buy side was expecting. So the real question is, are we in a trough, right? I obviously don't believe that. I expect more price cuts ahead, and I think that the price elasticity we saw was actually quite sloppy. But the margins on an adjusted basis, auto gross margins coming in essentially in line, would be taken as a positive. And the release didn't really have much in the way of discussion of further price cuts. We did see Ford lead with Lightning Pro price cut of $10,000 just this past week ahead of the Cybertruck official launch. So Tesla's been playing this game. Others are going to play it too. Let's be careful on that. I think that's a key part of the discussion on this call is going to be price elasticity and price cuts.
Greg, well, a lot of people are also looking at how this is affecting demand, right? With lower prices, you would think that would be a big boost to demand. But when you take a look at these global inventory numbers here, 16 days, that's up from 15. Not a huge jump, but does this signal maybe that we are starting to see lower than expected demand for Teslas?
Well, absolutely. I mean, you look at the fourth quarter to second quarter comp. I mean, you had roughly 15% price cuts, and it grew volume just 15%. That is tepid at best. I think, Tesla's dominated the market. They've done a phenomenal job, but competition's real. The environment is difficult. And they do acknowledge that in their release that this is a good quarter for them, considering the environment. And that's why I believe we're not seeing a more robust guide into the end of the year. They're still at that 1.8 million units, which means they are being a little bit careful, a little bit conservative right here.
Craig, you think the market is just too optimistic on Tesla? From the standpoint, yes, we all know they're lowering prices, but as we talked about when these numbers broke, they're investing a ton of money in AI and Cybertruck. Now, these things might pay off longer term, but they cost a lot of money today. Do you think Tesla's set up for some earnings misses in the back half of this year because of this aggressive spending?
Well, I don't necessarily think the spending is a bad idea, right? This is a technology company that is playing very efficiently, very effectively in the automotive market. I think where the misses are likely to come from, the reason that I'm very bearish versus my peers, is I think that competition is real. I think that people are much better off investing in other names in the space. I think that you're going to see some very successful vehicle launches from other OEMs, and you're going to see continued traction with some of these other vehicles. And that means that Tesla will lose share. They'll face pricing pressure, and that margins will continue to be under pressure. And that fundamentally is not a good setup. And things aren't going to get better in 24 than they are in 23. So, we're very bearish on Tesla right here. We see it as egregiously overvalued. We think people are much better off just, looking at many of the other names, either conventional auto OEMs or some of the emerging players as opportunities for investment.
Craig, how overvalued? Is this just a $100, $150 stock?
I have an $85 price target.
$85?
I think that, yes. If this stock was to trade in that range, it would be valued somewhere near Toyota. And Toyota has, 5x the number of vehicles roughly that they'll sell this year. Tesla does not have any technology that Toyota does not. Toyota is just a conservative company that delivers and delivers quality. Tesla, you look at the Cybertruck, their photograph shows mismatches on the door. They haven't come through with the wipers technology that they came. It's not an exoskeleton vehicle. I mean, Tesla's fallen short on that so many times, so many ways. Okay, this is not the commercial first vehicle, but there's obviously fit and finish problems. Toyota doesn't play like that. This has got a lot to learn.
Craig, $85. Just given where the results came in, do you think you'll take it down to $50, $60? I mean, do you have to make revisions?
So I'm always reevaluating my target, my thesis, right? And the one thing that would have me maybe make a more substantial change to my thesis is the work that they're doing around modular assembly. So this whole thing for the launch of the mini car, where they're looking to take out substantial cost in assembly, that's essential for preserving margins. It would be transformational for the industry. I've been bearish on that, kind of naysayer, but some of the auto executives are saying don't count them out. So I'm diligencing that. I don't see anything in this report yet that would have me dramatically change my opinion. I still think Tesla is egregiously overvalued right here.
Last week, Delta raising its profit forecast for full year earnings. So when we take a look at just all these airlines, you wonder if just some of the, especially for American, the expectations going into it, like it just had a lot of runway. And also, of course, the case for the stock, there may be some profit taking coming into this, right, Steve?
Well, this is characteristic of it goes into what Mark said about expectations being a little high for Netflix. They're high for American. I mean, I don't know if you've tried to fly this summer. I have, and
I'm about to.
It's not pleasant. I just booked a flight on American, by the way, recently, and so I'm gonna, I'll know if I see you in LaGuardia.
Yeah,
but I mean,
I will be in LaGuardia on Saturday, so maybe we'll see each other.
Not quite so quickly,
okay.
but this is a story everybody's known now. Is the airlines? People are traveling. The airlines are doing better. This is a much better environment for them. They're getting their balance sheets in order. But this is the problem. Going into earnings season is, have we set the bar too high? Mm-hmm. And so, if everybody's expecting good news, you really have to come up with something spectacular to justify it. And that's kind of at least so far, non-financially, that seems to be one of the themes early on. It's too early to really read it.
Well, and listen, we all like to talk about traveling. We all like to talk about airlines. In terms of an investable case, they're just not as heavily traded. Like when we talk about a Tesla, obviously Tesla blows everything else away. Airlines are super cyclical. Yep. They don't sort of keep to their capacity discipline over long swaths of time. You get people, remember when Warren Buffett was interested in airlines and like
I do remember
in a blip
that.
there?
But do you remember what he said? He said the fastest way to become a millionaire is be a billionaire and buy an airline.
Yes.
So, and then also you look at American year to date, I mean, it's up 46%. So even today's, move heading into the open is a blip to use your,
Right. I mean, so like just to put it in perspective, when you were talking about Tesla on your platform, like what about the airlines?
They don't register really.
Exactly what you said.
No, that fits with what you're saying. Yeah. It's not where people are thinking. Mm-hmm. It doesn't mean that there isn't a real institutional case for or against them, and that there aren't serious investors looking at them. But in terms of the average investor, it's just every so often you get them. They come to the fore, and they're kind of fading now because the story's out there.
Right.